ETFs can look simple at first, but the label only tells you the wrapper, not what is inside. An ETF is a fund you can buy and sell on an exchange during the day, and one share gives you a slice of a portfolio instead of a single security. To make sense of ETF menus without getting lost, it helps to sort them in two steps. First by what they hold, and then by how they are managed. Equity ETFs. These are ETFs that mainly hold stocks. Instead of buying one company, you buy a fund that can hold many companies at once. That basket can be very broad, like a whole market, or much narrower, depending on the fund. Your result comes from how the underlying companies perform, and that is why equity ETFs are often used as long-term core holdings. Bond ETFs. These hold bonds instead of company shares. That means the fund owns debt issued by governments, companies, or other borrowers. Part of the return can come from interest paid by the bonds, and part can come from changes in bond prices as rates move. So a bond ETF is not about owning a business. It is about owning a pool of debt instruments with a different mix of income, credit risk, and rate sensitivity. Real estate ETFs. These sound like a direct way to buy property through the market, but that is usually not how they work. In many cases, a real estate ETF holds listed real estate companies, or REITs, rather than direct ownership of buildings. So the fund gives you market exposure to real estate businesses, not the same thing as owning an apartment, a warehouse, or an office tower yourself. That matters because the fund can move with stock market sentiment, borrowing costs, and property market conditions at the same time. Commodity ETFs. This is one of the categories where the name alone is not enough. A commodity ETF may get its exposure in different ways. Some products hold the physical commodity, some use futures contracts, and some use related exchange-traded structures. That means a fund linked to gold or oil does not automatically behave like spot gold or spot oil in a clean one-to-one way. Before buying one, the practical question is, what exactly creates the commodity exposure in this fund? International ETFs. Here the main change is geography. An international ETF invests outside the investor's home market. Sometimes that means a broad fund spread across many countries, and sometimes it means a narrower fund focused on one region or even one market. This is not a new asset class in the way bonds differ from stocks. It is a change in where your exposure comes from, and that can add country risk, regional risk, and sometimes currency risk. Sector ETFs. These are usually still stock ETFs, but now the fund narrows its holdings to one part of the market, such as technology, energy, financials, or healthcare. That makes them different from a broad equity ETF that spreads your money across many sectors at once. The appeal is focus. If you have a strong view on one area of the economy, a sector ETF gives you a cleaner way to express it than buying a single company. The trade-off is concentration, because when one sector struggles, the fund has much less protection from the rest of the market. Index ETFs. Now the classification changes. Up to this point, the question was what the ETF holds. Here the question becomes how the ETF is run. An index ETF is built to follow a chosen benchmark instead of relying on a manager to make ongoing security-by-security decisions. In practice, that usually means the fund tries to mirror the index as closely as possible before fees. A lot of beginners treat ETF and index fund as the same idea, but they are not. An ETF is the wrapper, and index tracking is one management style inside that wrapper. Active ETFs. An active ETF uses the same exchange-traded fund wrapper, but the portfolio is not built just to mirror an index. Instead, a manager or investment team decides what to buy, what to sell, and how the fund should change over time within its strategy. That can make the fund more flexible, but it also means your outcome depends much more on the manager's decisions, the process, and the costs of running it. So the clean contrast with index ETFs is this. The wrapper stays the same, but the decision engine changes. One follows a benchmark, and the other gives the manager room to make judgment calls.